Leveraged exchange-traded funds, or LETFs, are specialized financial products. They aim to deliver multiples of the daily performance of an index. For example, a 2 times LETF seeks to return twice the daily performance of its target index. If the index goes up by 1%, the 2 times LETF aims to go up by 2%. LETFs achieve this leverage through the use of financial derivatives. These could include options, futures, swaps, and other instruments. These derivatives allow LETFs to magnify their returns. However, they also increase the risk of losses. This is why LETFs are often described as high-risk, high-reward investments. The mechanics of LETFs hinge on daily rebalancing. This means that the fund's holdings are adjusted at the end of each trading day to maintain the desired leverage ratio. This rebalancing is crucial for achieving the daily leverage target. However, it can also lead to significant performance divergence over longer periods. Understanding these mechanics is vital for any potential investor. Without this knowledge, one might underestimate the risks and complexities involved. LETFs are not just amplified ETFs. They operate on entirely different principles. Traditional ETFs and LETFs might seem similar, but they are fundamentally different. Traditional ETFs aim to replicate the performance of an index. They usually hold a diversified portfolio of assets. Their goal is to match the index's performance as closely as possible. LETFs, on the other hand, seek to amplify the index's daily returns. This amplification is usually by a factor of 2 times, 3 times, or even more. As mentioned earlier, they use derivatives to achieve this leverage. This makes their performance more volatile compared to traditional ETFs. Another key difference is the holding period. Traditional ETFs can be held for the long term. They are often used for strategies like retirement savings or long-term growth. LETFs, however, are designed for short-term trading. Their daily rebalancing can lead to performance decay over longer periods. This makes them unsuitable for long-term holds. Investors should also consider the cost structures. Traditional ETFs tend to have lower management fees. LETFs, due to their complex structure and use of derivatives, often have higher fees. These costs can eat into the returns, especially if the LETF is held for longer periods. LETFs offer the enticing prospect of amplified gains. If an index rises by 10%, a 3 times LETF might rise by 30%. However, the amplification works both ways. If the index falls by 10%, the same LETF could fall by 30%. In volatile markets, these losses can accumulate quickly. LETFs require a good understanding of market movements and a high risk tolerance. LETFs have been subject to increasing regulatory scrutiny. Regulators are concerned about the risks these products pose to retail investors. The complexity and high leverage can lead to significant losses. As a result, there have been calls for tighter regulations and better investor education. Before investing in an LETF, it is crucial to read the prospectus. The prospectus provides detailed information about the fund's objectives, strategies, risks, and costs. It helps investors understand what they are getting into. Skipping this step can lead to unpleasant surprises down the road. The prospectus also explains the fund's rebalancing mechanism. Understanding this is key to grasping how the fund operates. It also highlights the potential for performance divergence over time. Investors should pay close attention to these details. Regulatory bodies like the SEC emphasize the importance of informed investing. They provide resources to help investors understand complex products like LETFs. Taking the time to educate oneself can make a significant difference in investment outcomes. Ignorance can be costly, especially with high-risk products like LETFs. Section 5. Explain the specific instruments LETFs use, such as futures, forwards, swaps, and options. LETFs use futures, forwards, swaps, and options to achieve leverage. Futures contracts are agreements to buy or sell an asset at a future date for a predetermined price. Forwards are similar but are customized contracts between 2 parties. Swaps involve exchanging cash flows between 2 parties. Options give the right to buy or sell an asset at a set price before a certain date. ETFs use these instruments to hedge or gain additional leverage. Section 6. Describe the costs involved with LETFs, including management fees and transaction costs. Investing in LETFs involves several costs. These costs can affect the overall returns. First, there are management fees. ETFs typically have higher management fees compared to traditional ETFs. This is due to the complexity and active management required to maintain leverage. Transaction costs are another consideration. LETFs frequently buy and sell derivatives to maintain their leverage. Each transaction incurs a cost. These costs can add up, especially in volatile markets. Over time, they can erode the returns. Bid-ask spreads are also important. The spread is the difference between the buying and selling price of an asset. LETFs, due to their complex structure, often have wider spreads. This can increase the cost of trading. Lastly, there are costs associated with the use of derivatives. These include margin requirements, premiums for options, and potential counterparty risk costs. All these factors contribute to the overall expenses of maintaining an LETF. Understanding these costs is crucial for any investor. They can significantly impact the net returns. Investors should carefully consider whether the potential gains justify these expenses. In many cases, high costs can outweigh the benefits of leverage. Use examples like the Direxion Daily Financial Bull 3 X shares to illustrate how LETFs work. The Direxion Daily Financial Bull 3 X shares, or FAS, is a popular LETF. It aims to deliver 3 times the daily performance of the Russell 1000 Financial Services Index. If the index rises by 2%, FAS could rise by 6%. Conversely, if the index falls by 2%, FAS could fall by 6%. This shows the potential for amplified gains and losses. Daily rebalancing can lead to performance divergence over time. FAS might show a loss even if the index is unchanged. Higher management fees and transaction costs can erode returns. Understanding these examples helps grasp LETF dynamics. They illustrate both opportunities and risks. Section 8. Explain the impact of daily rebalancing on returns. Daily rebalancing is a key feature of LETFs. It ensures that the fund maintains its targeted leverage. However, this mechanism can impact the returns, especially over multiple days. When an LETF rebalances, it adjusts its holdings to maintain the leverage ratio. This process involves buying or selling derivatives. While this ensures daily leverage, it also means that gains and losses are compounded daily. In a trending market, daily compounding can be beneficial. If the index consistently moves in one direction, the LETF can amplify the returns. However, in a volatile market, the compounding can lead to significant divergence from the index's performance. Consider a scenario where an index oscillates up and down, but ends flat. A leveraged 2 times LETF might end up with a loss due to daily rebalancing. This effect is known as volatility drag. It underscores the importance of understanding the impact of rebalancing. Investors should be cautious about holding LETFs for extended periods. The rebalancing mechanism makes them more suited for short-term trading. Over longer periods, the impact of daily compounding can lead to unexpected results. Proper timing and market analysis are essential when trading LETFs. Section 9. Conclude with a discussion on the suitability of LETFs for short-term trading versus long-term investments. LETFs are designed primarily for short-term trading. Their daily rebalancing and use of leverage make them suitable for capturing short-term market movements. Traders can use LETFs to amplify their returns based on daily market trends. However, LETFs are generally unsuitable for long-term investments. The daily compounding and rebalancing can lead to performance divergence over time. This makes it challenging to achieve long-term investment goals with LETFs. The high costs and risks further complicate long-term holds. Short-term traders can benefit from the leverage offered by LETFs. They can quickly capitalize on market opportunities. However, this requires a good understanding of market dynamics and active management. Passive investors might find it difficult to manage the risks effectively. In conclusion, LETFs offer high rewards but come with high risks. They are best suited for experienced traders who can monitor their positions closely. Long-term investors should consider other options such as traditional ETFs for their investment strategies. Understanding the mechanics and risks of LETFs is crucial before making any investment decisions.